So today we will have a look at general ledgers. So this is chapter 4. We're gonna start with chapter 4 and then we'll go into chapter 3. I'll explain why we start with chapter 4, then go into chapter 3. So chapter 4 is general ledgers. I hope everyone can see. Everyone is fine. Let me just check. Can everyone see my screen? Can everyone see everything? Can I just have a raise of hand if everyone can see, or maybe a sharp? Let's see. Okay, everyone can see. Thank you so much. Let's continue. Okay, so we will go into ledgers. I'll just have a brief reminder from last session. We spoke about assets, liabilities, and equities. We had different examples of assets such as car, okay, they're called vehicles. We have furniture. We have bank. We have what else can be an asset? Yeah, there's a lot of examples for an asset. We'll go into them in more in depth. Liabilities, you have payables, you have loans. Or for an asset, you also have receivables. I hope everyone understands the concept of receivables and the concept of payables. You will use those two ledgers or country accounts quite a bit. So please ensure that you guys are focused and understand those two country accounts or accounts. Let's just say accounts, not to confuse you guys. So, and then you have equity. Equity is more of like your capital. We'll get into capital more. Your income slash expenses accounts. That's your equity. It's capital slash income slash expense. And then we'll talk about how each account affects each ledger. So, guys, please remember, this is very important in terms of ledgers or anything you do in accounting. Actually, in accounting, whatever you do affects two accounts. It's always going to be two accounts. It can't just be a single account. You understand further while I do more examples and explanations, right? So if I buy a car, it's going to affect vehicles, the vehicles account, and will affect bank account, right? Because I'm buying a vehicle for the business. Remember, this is go with the SIA Ltd business once again. So SIA Ltd business buys a Ford Ranger. That's gonna increase his vehicles, increase his assets, right? And what do we pay with for that vehicle? We pay with cash. And where does cash come from in our bank, in our business? It comes from our bank account. So that's gonna decrease our bank. You understand? That's just a brief example, but we'll go into it more. So, and that also applies for liabilities, also applies for income slash expenses slash capital. Everything you do affects two accounts. It's always two accounts, two or more accounts. More obviously if it's when we get into VAT, which will be I think chapter 6 or 7. I'm not too sure, but we'll get into VAT later. Right now, just learning on the basics and the fundamentals. Hope everyone can understand, and we'll go into it. So we have asset account, liability account, drawings account, capital account, expense account, income account. So this table is called a T table because you can literally see it forms a T right here. It forms a T table, right? Let's do like this. Let's present it. Ooh. No. Okay, let's not do this. Okay, let's not do that. I hope everyone's still in the session. Might have made a mistake. Okay, everyone's still in the session. Okay, short, perfect. Okay, let's continue. Can you please just remove your video? We don't need to see you. Let's continue. Okay, so what we do have here, let's put it in slideshow. Yes. So here we have asset account, liability account, drawings account, capital, expense, and income. So this is a T table. So a T table represents the left side and the right side. Left side would be debit, left side would be credit for assets. For liabilities, left side would be debit, right side would be credit. I'm sure you guys are confused when you see the plus minus minus plus plus minus minus plus plus minus minus plus. But don't worry, I'll explain further. So an asset, right? So let's just go back to that easy example. Say LTD buying a Ford Ranger. So remember, it has to affect two accounts. Either will be an asset account and an asset account, or maybe an asset account and a liability account, or a capital account and a asset account. You understand? So it can go interchangeably. They can use any other asset account, but as long as it's two accounts, you understand? So go back to that easy example. So say LTD buys Ford Ranger, buys it with cash. So I've paid cash for my Ford Ranger. So for an asset account, in this T account, the plus is on the debit, the minus is on the credit. Right? Remember, the two accounts that we will deal with is vehicle, because the Ford Ranger is a vehicle, and bank. Those are the two T accounts we'll deal with. So it's two asset accounts, right? So me buying a Ford Ranger, it will, let me see. Okay, we'll go into the examples. So it'll basically increase my vehicles that I have in my business. And where is the plus? The plus is on the debit side, it's on the left side, right? So I'll put the country account will be bank, like right here. Instead of this, I'll put bank. Don't get worried, guys. We'll go into an example. We'll put bank here, then, and this is gonna be a vehicle account, and then the other T account will have another T account or written bank on top. We're gonna have plus, minus, debit, credit, and you're gonna have vehicle on the right hand side. You understand? Because we're using two accounts. The bank account having a minus as vehicle represents that we have used cash to buy the vehicle. Let's get into an example. Maybe I'm confusing you guys. So this is an example, is an asset, right? This is July 1st, purchase equipment and pay 4,000 per EFT. Per EFT means cash. They put it cash. Someone's raising their hand. Hold on. Did anyone raise their hand? Okay, no one raised their hand. Perfect. Okay, let's go back to this example. Okay, open it up again. Okay, so CLTD purchases equipment and pays 4,000 per EFT. Per EFT means they've used bank, they've used cash. They paid it with cash. It's EFT. You understand? Either tapped it, they sent it, they paid it with cash. So here we have two accounts because they fix two accounts. So you first do your T table. You're gonna have not cash, it's not be bank, it's not cash actually, it has to be written bank. So you do your T account, you have DR on the left side, CR on the right side, debit, credit, right? And if I was you guys, please write the plus and minus to know where it increases, where it decreases. You understand? In the textbook or anywhere else in slides, you won't tell where's the plus minus. You guys should just know where's the plus minus. In terms of assets, the plus is on the left side, which is debit. The minus is on the right side, which is credit. So I bought equipment for 4,000. Me buying equipment for 4,000 is going to do what? It's going to I'm going to, I bought equipment for 4,000, so it's gonna decrease. Remember, it's a plus, it's a minus. I'm gonna decrease my bank. That's why I have a 4,000. Let me see if it's possible if I can just write the plus minus. This is the plus, this is the minus. Let's go back here. So it's going to what? Decrease my bank. And it's gonna be 4,000, decreased by 4,000 because I paid cash. 4,000 rand is coming out of my bank account to pay for the vehicle. 4,000 rand. That's why it's 4,000 here. The reason why they wrote equipment, because you can't write bank as the account. Because remember, what account is it affecting? It's affecting equipment. That's why they write equipment. It shows in my bank leisure, general leisure, I spent 4,000 on equipment. That's how you should read it. So I purchased equipment and paid 4,000, right? My bank account, bank general ledger, I bought 4,000 worth of equipment. 4,000 worth of equipment. Your story must make sense. Look at it as a story. I can't say, okay, purchase equipment and pay 4,000. I can't say, okay, I paid 4,000 rand and I put bank. Doesn't make sense. I paid 4,000 rand for what? I can't say I paid 4,000 rand for bank. That there's no such thing as paying 4,000 for bank. I paid 4,000 rand for equipment on this date, July 2009, on the 1st. This is the year, this is the month, and then this is the date. It's a story, guys. It's literally a story. For now, you can ignore this balance. We'll get into the balance part. But like, if we just focus on this, 4,000 rand for equipment on the 1st of July 2009. The T accounts basically gives you a short description of what you guys did. And remember, it affects two accounts. So since I paid 4,000 for equipment, what happens to my equipment? So what happens to my equipment is, where's my pen? And remember, this is a plus because it's an asset account, minus. Every asset account is going to be a plus minus. It increases on the debit side, it decreases on the credit side. Increase on the credit debit side, decrease on the credit side. So now since I bought equipment for cash through bank, it's gonna do what? Ignore this balance. It's gonna increase my equipment. This is why you see that it increased my equipment by 4,000 and had to repay that increase of equipment through bank. It's not cash, it's bank. Remember, this account goes here, this account goes here. You understand? You have to understand the principle, you have to understand the story behind each transaction. It's basically, the T account is basically telling a story behind each transaction. A short story, a short description. You understand? But guys, please, even if you guys are cram, please cram plus minus for asset account. You know it's gonna increase on the debit side, it's gonna decrease on the credit side. And these are called country accounts. These country accounts has to be the correct description. It has to be equipment, it has to be bank. It can't be like on this account bank, it can't be on this account equipment. It's not gonna make any sense. Your story must make sense. You must look at it as a story. So here you see, okay, it shows, oh, this person say ultimately bought equipment through bank for 4k, and then look at bank. Okay, let's see bank, if it's they double check if it's true. Oh, okay, equipment for 4,000. Oh, okay, so the books balance, the books make sense. Is anyone asking a question? Hold on. Let's see. Is anyone asking a question? No one. Okay. If you guys don't understand, please do say. If you guys don't understand, I will repeat and ensure that you guys understand fully. Okay, so let's just go back. That was assets. Please, guys, remember plus minus, increase in the debit, decrease in the. Me saying plus minus just tells you that plus, it's always going to be debit, it's always going to be credit. So plus means, okay, it's an increase in the debit. Minus means also a decrease on the credit side. Please understand this. It's very, 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 very important, guys. I cannot stress it enough. So, let me go into liabilities. So remember liabilities. Liabilities. Let's do this. Liabilities it's different. It's a minus. It's a plus. It's what happened there? And let me just erase that. Sorry about that. It's a minus and it's a plus. It's a minus, it's a plus. And remember, guys, remember when I told you payables and receivables is an important account you guys should understand. Receivables is an asset, payables is a liability. They use this very frequently, guys. I remember furniture is an S. Ooh, okay, sorry about this, guys. I did not read this properly. My mistake. Please don't get confused. This is an asset. This is a plus. This is a minus. Yeah, it's a plus. It's a minus. I apologize for that. I hope I didn't confuse anyone. So, asset, T account, furniture. Furniture is an asset. It's tangible. It's something Tia Ltd owns because they bought it. Now let's look at this example. Purchase furniture on credit. On credit, when you see on credit, just understand on credit means you're gonna use a payables account. Payables accounts. You're gonna use payables. When you see this, it's gonna do payables. As soon as you see on credit, just think of payables. As soon as you see on credit, think payables. And remember, what's a payable? It's a liability. What is credit? It's a liability. You understand? Okay. So now, purchase furniture. This is an asset on credit liability from Furniture Ltd for 1,000. So Sia Ltd purchases furniture. Ignore the balance. I purchase furniture. Open a T account for furniture. Debit, credit, increases on my right, decreases on my left, decreases on my right. Increases on my left, decreases on my right. Yeah, debit, credit, plus, minus. So now, say Ltd purchasing furniture. So our furniture within the businesses, I have more furniture. Me having more furniture, it's gonna increase my furniture. That's why we put it on the left. It increases because plus minus increases on the debit side, right? And remember, your story must make sense. Your country account must make sense. Me buying the furniture on credit, it affects two accounts. It affects furniture and also affects payables, right? So that's why you can see 1,000 rand increase of furniture, and which account? Payables on the 3rd of July 2009. So we go back to our other T account, because remember it affects two accounts. So now we open a T account for payables. Since it's a liability decreases on the left, increases on the right. So asset and liability, it switches over, it's opposite. So with asset, it increases on the left, decreases on the right. With liability, it increases on the right, decreases on the left. It's always opposite. So you open a T account for payables, and you can see that it increases because remember our payables. Now we have more things to pay. Remember, guys, payables to explain it, it's literally in the name. I'm buying furniture and I have not paid for it. I'm using credit to pay for the furniture. I still have to pay for the furniture. It's a payable. And I said it's within the name, payable. And you open a T account, payables, Furniture Ltd. So that's how you see a 1,000 rand increase in my payables for what? Furniture. You understand? Because my business, it shows two accounts. I increased my furniture by 1,000 rand, and I paid it how? Through payables. And it also, I have to show how am I paying for this furniture. I'm paying it through payables. It's a payable. I'm gonna pay it. You understand? With 1,000, and increases my payables with 1,000. And what account am I using? Furniture on the 3rd of July 2009. Also, yeah, 3rd of July 2009. Dates are important. Country accounts are important. And yeah, I hope everyone does understand. Please say if you don't, I will re-explain. And for now, it's it's not an easy concept to understand, but it's a concept that you guys have to understand. It's fundamentals, the absolute fundamentals. You'll get more challenging further with other topics when they integrate other topics in 1, 2, 3. But for now, you should not stress. This is just the basics, and this is how we're gonna start. Is anyone raising their hand? Let's see. Okay. Yes. You can unmute. Mnelisi. You can unmute. Your hand is up. Mr. Mkwazi, you can unmute your mic. Okay, maybe it was a mistake. Or you can just okay.
I want to ask about country accounts.
Yes.
That if you want to put the country account, it must be the same as the name on top of the ledger.
Yes, as the account that is affected.
Oh,
Yes, because
well,
as you can see here, it says furniture. You bought
yeah.
furniture, and or whatever. What did you as a payable? It's also furniture. It must make sense. It must show which accounts are being affected.
Okay, thank you.
Yes, thank you. Can mute your mic. Does anyone have questions? Okay, no one has questions. Fine, it's fine. If you guys don't feel like unmuting your mic, you can just type in the chat box, nah? It's fine. I'll attend to them. Okay, so we're gonna move on to equity. So equity is, remember, it's capital, it's income, and it's expenses. Those are the three that falls under equity. And equity, luckily for you guys, okay, luckily it's the same minus plus as liability. It's the same. So let me just write it down for you guys. It's the same. It's a minus. Sorry about that. It's a minus. It's a plus. Capital falls under equity. Capital is essentially when Siabonga decides to start a business, I have to have what? Capital to start my business. I can't just start my business with no money. The money that I'm putting into this new business is what you call capital. You understand? That's what you call capital. You can capital can come in other forms too. It can come in as a vehicle, like me, Sabonga. I use my car as my capital. I use my car to use for my business, so that's gonna be regarded as capital. 6 months down to into the business, I just put in more money into the business. That is capital. Capital is it's easy account to understand. It's just money that I put into the account. The owner putting money into the account, into the business bank account. That's essentially what capital is, and it falls under equity. Sorry about that. So, and remember, okay, let's look at this example. July 14th, as AB Office Services plans to extend, as Siabonga Ltd plans to extend, the owner owner, Usia, the owner deposits 5,000 of his personal funds into the entity's bank account, into Sia Ltd. I hope you guys are seeing this yellow. If you guys can't, please say, I'll change the color. So as Sia Ltd plans to expand, the owner Usia deposits 5,000 of his personal funds into the entity's bank account. So my own money I put into Sia's Ltd's bank account, the bank account of the business. I put my own 5,000 rand in the bank account of the business. You understand? So this is recorded as capital because I'm using my own money into the business. So remember, it has to affect two accounts. Everything affects two accounts. In this situation, it affects bank, the business bank account, so it's bank, right? And then it also affects capital, right? Because it's my own money, so it's bank, the business bank account, and this is what capital, owner deposit. So when you guys see owner deposits, just it must click into your head that it's okay, it's capital. You understand? And obviously the owner can only deposit money into the business bank account, so it's obviously will affect these accounts. These are called accounts, it's called country accounts. These accounts, you understand? So it's not cash, it's bank, guys, please remember that. And let me just see, where is my pen? So it's gonna be bank slash cash, it's a plus and it's a minus. Remember, equity and liability is a minus plus, asset is a plus minus. So if I was you guys in the test, if you guys still don't understand, just small in the corner with a pencil, just say asset plus minus, liabilities minus plus, equities minus plus. You understand? So you can just don't get twisted or just you don't forget. You understand? So yeah, and obviously with asset increases on the debit side because it's a plus, and then decrease on the credit side because it's a minus. And then with equity, same thing. Capital increases on the credit side and decreases on the debit side. You understand? It's the opposite, like liabilities. Okay, so let's get back into it. So owner deposits 5,000. So it's gonna increase the capital of the business because I'm putting money into its capital. Increases, so it'll increase this side. So increase this side, 5,000. Right, and then remember with bank, I deposited 5,000 into the business bank account. So the business bank account is gonna have more money. It's gonna be 5,000 more. That's why it's a capital, and it's also the 5,000. You guys please understand these country accounts must be aligned with the ledger accounts. Cash, actually bank, capital. So the two accounts that it affects, it must correspond. It's a, you can see it's a cross match. You can see there, and as you can see here, it's a cross match. You can see it. Okay, it makes sense because the capital increased by 5,000. How did it increase by 5,000? With depositing 5,000 cash on the 14th of July, 2009. Understand? It must make sense, guys, your story. You can't just say 5,000 and just write a random account drawings because you don't know how it affects. It won't give you that mark for the country account. That might give you a mark for the 5,000, but the country account is marks for country account. So then you have to write the correct account here. You understand? Let me just make it more neat. So This is equity. Equity, remember, it's income, expenses, and capital. Capital, it's very easy to spot, guys. It just most of the questions are literally like this: the owner deposits into the business bank account, or maybe they might change it up and say the owner contributes his vehicle to the bank, to the bank, his vehicle to the business. That means that obviously what you're gonna have now, you're gonna have capital and you're gonna have vehicle, because there's more vehicles in the business, and obviously there's more capital that you've the owner has contributed. You understand? So yeah, this one is fairly manageable. And then we'll go into expenses. Remember, expenses fall under equity. So remember, let's do this again. So AB SEA Ltd pays monthly salaries of 1,500 to its employees, guys. 1,500 to its employees. So salaries is a expense for a business. It does not bring you money. You're paying people. So what's that? An expense. Doesn't bring you money. Pays monthly salaries for 1.5 to its employees. So that's an expense for the business. It's not a profit. It does not bring you any money. You taking out money. You're using the account, the money of the business to pay your employees. Right? Okay, let's get back into this. So now, yeah, so you're gonna have, how does AB Office Services pay monthly salaries? It pays it through bank. They use the money the business has. So how do we pay expenses in this business? We pay through bank. You understand? So that's why it's a cash T account. And then what's the other account? Salaries, because you paid salaries as the expense account. Asset account, expense account. You understand? So these are the two accounts that are affected in this transaction, right? So let's look at the story, because remember, the story has to make sense. So asset plus minus, and then you have, this is an expense. An expense is equity. So wait, hold on. Wait, hold on for me. I'm trying to check something. Hold on. It's gonna be a minus. It's gonna be a plus. Because remember, it's equities. Minus, and it's going to be a plus. So wait, hold on for me. I think there's something wrong with this account. Bank. I use bank too. I'll correct myself if I'm wrong. I think there's a mistake here, but let's continue. Okay, so I paid 1.5 of salaries using the bank of the bank account of the business. So that's why we have 1.5 paid. It's money going out. It decreases the bank salaries, as you can see, and then salaries, you paid it with bank 1.5. You understand? So guys, another thing I want to explain to you guys, né? As you can see with these accounts, né? It's very visible that you can see that payables is on the left side furniture is on the right side. You can't have payables here and furniture also here. You can't have furniture also here. It can't be a debit. It must be a debit, credit, credit, debit, debit, credit, credit, debit. It's never will be a debit. Never. It's impossible because you have to explain what are the two accounts that it affects. If it was a debit in this situation, it increases furniture with 1k and then decreases payables with 1k. Doesn't make sense. You understand? That's why I'm a bit confused with this one, but we'll get back to it. Don't worry, guys. So yeah, it decreases bank with 1.5. Oh, okay. I'm so sorry, guys. Now I understand. Okay, so with expenses, it's also a plus minus. That's why it's like this. So income, and the liabilities and capital is a plus. It's a minus plus, but with expenses and assets, it's a plus minus. That's why it's like this. Now I understand. That's why it's like this. So we paid 1.5 through the business bank account. So it's gonna affect the bank account money is going out, and it's gonna increase the salaries 1.5. This shows cash because it's never debit or credit. That's be debit credit or credit debit. Someone's hand is up. Hold on. Oh, just a reminder that the call is ending in 15 minutes. So class will end in 15 minutes. Let's push. Let's continue. Yeah. So that's expenses, guys. Expenses are plus minus, increases on the right, decreases on the left. Assets increases on the right, decreases on the left. Plus minus, plus minus. Please, guys, when you're writing the test, assets plus minus, expenses plus minus, income minus plus, capital minus plus. Please, those are obviously liabilities also minus plus. Please, guys, please do remember that. Even if you put it down on paper and you climb it, please do. But you have to understand the principle behind these. Sorry about this. You have to understand the principle behind the plus, minus, and minus plus, right? Okay, let's go into the income example. So the income example here, remember income. Remember that I said it's a minus plus. Let's write it down. Minus plus, and cash, which is bank, is an asset, and that will be plus minus. Okay, let's look at the example. So July 28th, AB office services received 1.9 cash during July for rendering, photocopy, and typing services. Rendering means I did a service for you. Understand? Rendering, photocopy, and typing services. What they did here, AB officers got money for doing photocopying and typing services for whatever company. That's the most simplistic way to understand this question. This is like transaction. So they received 1.9 cash for printing, photocopying, and typing services. So it affects two accounts. It affects cash because we receive the money. The business is receiving money, and what else? We also we basically did a service. We worked for them. It's a service. Services rendering services. So these are the two T accounts. We have cash T account. We have services rendered T account. Services rendered is rendering a service. Please remember this account, guys. Please. You'll get this often. I think you'll get in every test, to be honest. So yeah, you have cash / bank T account, and you have services rendered T account. These are the two accounts that it affects. So remember that I told you that you cannot have a debit and a debit. It always has to be a debit credit or credit debit. You understand? If it's a debit, it's not gonna make sense, guys. It literally just does not make sense. If it's debited cash, it increases the cash, and debited services rendered, it's decreasing services rendered. That does not make sense, guys. Please, your story has to make sense. You must tell a good story that makes sense. In this situation, we received 1.9, so our business bank account is growing by 1.9, increases by 1.9. That's why it's a plus. It's plus side, the debit side, because we're increasing the money, right? Okay. If it's services rendered, so services rendered is it's an income account. You understand? So income increases on the right hand side, decreases on the left hand side, increases on the credit side. So this will increase by 1.9. Increases by 1.9. And the country account is bank cash slash bank services rendered. You can see services rendered, cash. It must cross reference. It must make sense. If your country account is wrong, you won't get the mark for the country account. You won't get it, guys. So I want you guys to get the full maximum marks, guys. Do you understand? Please understand what is the income, what is expenses, what is asset, what is liabilities, guys. Once you guys know what's income, what's expense, and you just throw the two accounts without just doing any transaction before you even start any of your, just throw them fast. Income minus plus, expenses plus minus, asset plus minus, liabilities minus plus. Knowing that you know what is income, what is liabilities, what is asset, it's gonna be easy for you guys. You can literally breeze through it and get full marks. Please, guys. Nah? So I'm gonna let's keep it. So guys, I need to please understand these concepts, guys. Please do understand them. It's really easy to understand. It really is easy to understand. If you guys can just understand what is a debit, what is credit, where it increases, where it decreases, what are the expenses, what are income, what is liabilities, what is assets, right? I'm gonna touch just a little bit on chapter 4, which is the accounting equation. Won't have enough time, guys, but it's fine. We still have another time. Do this. If you guys don't understand, please do say, guys. I'm here for you guys. I understand all of this. I've wrote all of this, so I'm just here for you guys. Né? So this is the accounting equation. This is chapter 4. I'm gonna touch just briefly on it before our time is up. We'll touch briefly on it, but the accounting equation is very easy if you understand general ledger. And so that's why I wanted us to start with the general ledger before the accounting equation, because chapter 4 is actually general ledgers and chapter 3 is accounting equation. You understand? Once you understand the general ledgers, accounting equation will be easy for you. You understand why is it a plus minus. You understand. You understand. I'm just touching it very briefly, guys. We'll just go in a small example and we'll further continue on a lesson later this week. I'll communicate. So Sia Ltd purchases an asset for cash transaction. Remember cash, you know what's cash. With the highlighter, let's do this. Purchases for cash, and remember cash, guys. I said for cash. The cash is bank. If you see paid via EFT by cash, it's bank, guys. Please remember bank. Purchase additional equipment. Equipment is an asset. If you guys understand what's an asset, guys, it's gonna be easy, guys. Please trust me, guys. Purchases an asset, which is the equipment for cash. So bank and equipment are the two accounts that you're gonna deal with. From Suppliers Ltd for 4,000 rand, the equipment was received on the 1st of July, immediately paid 4,000 to suppliers by EFT, electronic fund transfer. Remember, when you see these words, just know bank. Bank is one of the T accounts. It's going to be one of the T accounts. You understand? And then let's just go into it. And remember, the T accounts. You have bank, you have equipment. Right? Remember, plus minus, because they both asset account. Bank is an asset, equipment is an asset. And see what happens here. So we bought equipment for 4,000. It increases our equipment by 4,000, and what it does to our bank, it decreases our bank by 4,000. You understand? Increase, decrease. You understand? So now the accounting equation goes like this: assets equals liabilities plus equity. So now in this case, we bought equipment, it pluses equipment by 4,000, and then we bought it for cash, so it decreases our cash. Remember, these are the two assets, asset. So you put it under asset column. Equipment asset by 4 plus 4,000, bank slash cash decreases by 4,000, which will give you 0, because A assets equals E equity plus L. It didn't affect any of the liabilities, it didn't affect any of the equity. That's why the account equation will always be correct. A equals L plus E. It always must align, it always be the same. Assets will always equals liabilities but equity. With further examples, you'll understand what I mean. Let's just touch on a quick example before time runs up. Okay, so in this situation, you have where's my highlighter? Purchasing an asset. You see now. Purchasing an asset. What's going on with this highlighter? Oh, I haven't clicked it. Purchasing an asset on credit. Remember, when I buy something on credit, it's gonna be a payable. When you see on credit, just think of payable. Same time, you're like, okay, that's a payable. And what is a payable? It's a liability. How does liabilities work? Minus plus. Decreases on the left, which is debit, increases on the right, which is credit. And remember, asset, purchases an asset. Okay, what type of asset? The asset is received at the time of purchase, while payments will be made later. It doesn't say what asset. I think I didn't put in the full example for the transaction. But let's see which T account will it affect. It affects on credit, means payables, and an asset, it should say furniture. Apologies for that. Furniture. So these are the two accounts it affects: payables and furniture, right? So we increased our payables because we bought an asset on credit. So increased payables 100 rand, and then it increased our furniture because we have more furniture now by 100 rand. Debit 100 rand, credits 100 rand. You can see it's always cross references, guys. The country account here will be payables, the country account here will be furniture, because remember, the story must make sense. And then with the accounting equation, as you can see, assets plus by 100, furniture, liabilities plus by 100, payables. Can you see now? So A, which is asset, is 100 rand. 100 rand equals the 100 rand payables. Equity is going to be 0. So assets equals liabilities, which is this 100 rand, plus the equity, which is 0. So 100 equals 100. You understand, guys? The accounting equation is simple to understand once you understand the ledgers, guys. Please, guys, please. It really is simple once you understand the ledgers. We're going to more examples on our other session. It won't be enough time to cover the more examples, but I just wanted to touch a bit of it on those two chapters. These two chapters are very important. It takes majority of your marks. It's always for test 1. It's always theory, and then it's general ledger and accounting equation. I think there's one more topic for test 1. I'm not too sure, but I think there's 4 chapters or 5 chapters for test 1. So guys, please do understand these chapter 3 and 4 are very important. Even chapter 1 and 2, guys, because those are your theory marks. Theory marks, you guys must get 100% for theory, guys. Please, it's just theory, guys. Cannot be getting 1 for theory out of 10 or out of 15. You have to get at least 12 out of 15, 13 out of 15. You understand? And you get your marks for other chapters, guys. Please, guys, thank you for attending this lesson today, guys. Unfortunately, we ran out of time. I really am enjoying teaching you guys. I want you guys to understand these concepts, these fundamentals, so you can be prepared for test 1, test 2, test 3, guys. Please, guys, thank you.